Today, we're diving into a critical topic for any American living abroad: investing overseas, or even just holding foreign bank accounts. FATCA. You've probably heard the acronym, but what does it actually mean? Why does it matter so much? In this video, we're going to break down what FATCA is, who it impacts, and how it affects your finances as a U.S. citizen abroad. Okay, so if you're a U.S. expat, this is pretty much a must-watch video. So what exactly is FATCA? FATCA is an acronym that stands for the Foreign Account Tax Compliance Act. One more time. Foreign Account Tax Compliance Act. It was passed in 2010, so it's relatively recent, and its main purpose is to prevent tax evasion by U.S. citizens who have financial assets outside the U.S. In a nutshell, it requires U.S. citizens to report their foreign financial accounts and assets to the IRS, and it also requires foreign financial institutions to report those accounts to the IRS as well. Okay, so this is kind of the act or the provision. That's the whole reason it's hard for Americans to open bank accounts abroad, and why banks don't want to deal with U.S. citizen clients, because it's just so much of a hassle due to FATCA. Why? Well, before FATCA, it was pretty easy for people to hide money in foreign bank accounts and avoid paying U.S. taxes, and there was just overall a lot less reporting, okay? So you as an individual did less reporting, the banks overseas that held your money did less reporting, but FATCA changed all that by introducing global oversight of U.S. account holders. So who does FATCA affect? Who needs to worry about this? The short answer is, if you're a U.S. citizen with foreign financial assets, this law applies to you. This includes expats living abroad with bank accounts in their host countries, U.S. citizens with foreign investments like mutual funds or bonds or real estate, even green card holders and U.S. residents with significant foreign assets, right? Maybe if you're a green card holder, you're obviously from a different country, and anything you had from before, you became a green card holder still needs to be reported. So even if you don't physically live abroad but hold investments or bank accounts overseas, you're required to comply with FATCA. There are thresholds for reporting, by the way. If you live in the U.S. and have foreign financial assets worth more than $50K, or you live abroad and have assets worth more than $200K, you'll need to file Form 8938 with your tax return. Okay? If you live in the U.S., $50K. If you live abroad, $200K. Let's talk about some of those reporting requirements for U.S. taxpayers in more detail. So if you fall under the FATCA umbrella, what exactly do you need to do? Let's break it down. First thing is Form 8938. This is the form where you report your foreign financial assets, actually foreign assets of any kind. It's filed along with your annual tax return and asks for details like the names of financial institutions, the maximum value of your accounts during the year, and other information about your foreign assets. 2 is the FBAR. Now, don't confuse FATCA with FBAR. FBAR is the Foreign Bank Account Report. While they're both about reporting foreign accounts, FBAR has different thresholds and requires you to file if you have over $10,000 in foreign accounts at any point during the year. You'll need to file FBAR with the Financial Crimes Enforcement Network, FinCEN, not the IRS, by the way. Another thing is tax liability. So reporting doesn't always mean you'll owe additional taxes. FATCA is all about transparency and compliance and reporting. And if you're paying taxes in a foreign country, with foreign tax credit or foreign earned income exclusion might help reduce your U.S. tax liability. Okay, so FATCA is more of a reporting thing, not a tax in and of itself. Now let's examine FATCA's impact on foreign banks and investments. let's flip the perspective for a second. FATCA doesn't just affect U.S. citizens. It places obligations on foreign financial institutions too. Banks, investment firms, and other financial entities abroad are required to identify their U.S. clients and report information on their accounts to the IRS. So what happens if a foreign bank doesn't comply? Well, they face a 30% withholding tax on certain U.S. sourced payments like dividends or interest, and because of this, many foreign banks have decided to close accounts for U.S. citizens, making it harder for Americans abroad to open or maintain accounts. This aspect of FATCA has caused frustration for many U.S. expats. Some have had accounts closed, while others struggle to find financial institutions at all willing to work with U.S. citizens. Like, how annoying is that? You're a U.S. citizen, maybe you're freshly abroad living in a new country, and no one will even open a bank account for you because you're a U.S. citizen. You're getting literally discriminated against by these institutions, but you can kind of understand their perspective. You're a less profitable client. It's a huge hassle. They're like, it's not even worth it. So that's kind of the situation we find ourselves in as Americans. Let's come back to penalties for non-compliance, right? So what if you fail to comply with FATCA? The penalties honestly can be steep. If you don't file Form 8938 when required, you could face a penalty of $10,000. And if the IRS requests information and you still fail to report, that penalty can increase to $50,000. For FBAR, the penalties are even more severe. Failure to file an FBAR can result in penalties of up to $10,000 for non-willful violations. And for willful violations, and who knows how they, determine that, but for willful violations, it can go as high as $100,000 or 50% of the balance in the account. Literally, they'll take 50% of the money in the foreign bank account if you fail to report it. These fines are no joke, so staying compliant with FATCA and FBAR is crucial. So here are a few tips to help you stay on the right side of FATCA and avoid those heavy penalties. 1, know your thresholds. Make sure you understand whether your foreign accounts and assets meet the reporting thresholds. Even if you're not sure, it's better to double check than risk non-compliance. 2, work with a tax professional. If you're living abroad or have significant foreign investments, it's a good idea to work with a tax professional who specializes in international taxation. They can help you navigate the complexity of FATCA, FBAR, and any other reporting requirements. Next, keep detailed records, right? Ensure that you're keeping records of all your foreign financial assets, all your transactions, and this will make it easier to fill out your forms and prove your compliance if needed. And don't forget FBAR. Remember that FATCA and FBAR are separate filings with different thresholds, but both may apply if you have foreign bank accounts. So there you have it. FATCA may seem like a big, intimidating law, but it boils down to making sure Americans with foreign financial assets are reporting them to the IRS as they should. Again, of course, as a U.S. citizen, you're taxed on your worldwide income, so it only makes sense that they want to keep track of your assets worldwide. And while it's been a headache for some, staying compliant is the key to avoiding penalties and staying on good terms with the U.S. government. If you found this video helpful, make sure to give it a thumbs up, subscribe to the channel for more content on living and investing abroad. And as always, leave any questions you have in the comments, and we'll be happy to help. And if you need a U.S. lawyer or accountant with a specific focus on international tax concerns for U.S. citizens, such as filing FATCA, filing the FBAR, filing the foreign earned income exclusion, get in touch with MyLatinLife, and we'll point you in the right direction. Thanks for watching, and remember, whether you're living abroad or just investing internationally, staying compliant with FATCA is crucial. See you in the next video.